Welcome back to America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker, Jeremy Baker, no relation, and Chaz Price. 419-794-3030 is the phone number. 419-794-3030. Online, americasretirementheadquarters.com if you missed the first segment, or you just want to check out previous editions of the show. Go to Facebook, go to YouTube, Spotify, pretty much wherever you want to go to access media. Search for America's Retirement Headquarters. Previous editions of the show there available for you to check out. So guys, a story from CNBC talks about one drawback that retirement savers may encounter when they roll over a workplace 401k into an IRA, and that is higher investment fees. In fact, a study found that the typical hybrid fund in a 401k plan charges about 0.20% less than the same fund in an IRA, which, again, 0.20, not 20%. It doesn't sound like a lot, but it could end up costing retirees thousands of dollars, which, that is significant. So can you guys help clients in this situation make sense of it all so that their money isn't being eaten up by fees?
Well, I'm really happy that fees have been kind of the spotlight for the last, 5 years or so, because what you've seen in the industry is, fees have continued to come down. There is a big difference, I think, between different financial products that are offered and what the expense ratios are. Variable annuities, as an example, in my opinion, is one of the most, costly financial products that are out there when you add up the, sub-account fees, the mortality and expense charges, the rider charges. It can get costly, and that doesn't mean the cheapest is always the best either. Fees don't always have to be higher in an IRA relative to a 401k. A good example is we work really closely with Charles Schwab. I think between Charles Schwab, Vanguard, and Fidelity, there's some really good choices that are out there in providers, whether it's a 401k or an IRA, to have costs down. Another thing to do is to look at what type of share class you're going to get involved with. So there's like Class A, Class B, Class C, there's load-waived Class A, and there's also institutional share classes. So, sometimes those institutional share classes can be lower expense ratios too that are out there. You really got to kind of slice and dice when you're looking at the fees and expenses that are a part of a portfolio. Going back to Chaz, what you were saying before, there's things that we can control and there's things that we can't control. So we can't control what the market's going to do. As we talked about earlier when we were talking about, even the Federal Reserve, so, some of the highest powers that be for making financial decisions for our country, even admit they got it wrong. The markets are somewhat of an uncontrollable, but fees and expenses is definitely an area that is controllable.
Yeah. And this is an area that I've spent quite a bit of time really working on and studying as an advisor. I grew up in a small business family, and that's always been a passion of mine, is retirement planning for small business, closely held families. But one of the terms, I guess, or one of the thoughts that I've always had about fees, Chris, is that fees really only matter to me in the absence of any value. So if I'm paying a fee for something, I'm okay with that as long as I know what I'm paying for. And to me, just the fee alone is not enough decision or not enough information to make a decision about. I need to know a couple of different things in terms of the plan itself. What do I have access to, and what am I getting for that fee? And so I use the analogy of shopping. I mean, going to the grocery store. I think most of us have done that. Some of us have lists. Some of us are just kind of roamers. But one thing that I think we all agree upon is that what we pay for something, when we see what the price is on the shelf, when we go to check out, that's exactly what it should be. And imagine going to the grocery store and you're assembling all, your cart, and you've got this big cart of groceries, and there's no screen. There's no way of you knowing, as the cashier is running your items, what it's actually, what they're charging you for it. And at the end, the cashier gives you, a bill for $300. And you're like, well, I don't know. I didn't get to see what this cost. You didn't have any price tag on the item. That, to me, is really the 401k industry, is that, you go into the situation where somebody tells you, inside of this store, you can go to aisles 3, 4, and 5, and on the bottom 2 shelves, that's all you can shop from. And you do your best that you can, but by the time you get to the register, you don't know what you're paying for these things. You don't know what it's costing. You don't know what the value is. And so as a financial advisor at the Retirement Guys, we can run your receipt. And that's actually what we call it. If you bring in the statement, maybe even a breakdown of what other options are available to you in that 401k, we'll run your receipt. We'll let you know what some of these things are costing you, because the biggest component to what fees you're going to pay in a 401k, it's not the actual account. It's not your actual investment. It's the investment of the overall plan. It's how much money the company has. And so basically, the bigger the company, the lower overall fees that you as a participant in that plan are going to realize, because of the economies of scale, compared to a smaller employer maybe that only has a couple of employees. Maybe they're just starting the plan. My job, one of my responsibilities is to incept 401ks for employers, and that's one of the things that we look at. There is often a plan-based fee that could be anywhere from I've seen it as high as 2%, could be as low as 0.25%, just depending on how much in assets are in that plan. And so looking at the actual investment account fees is not enough for you to make a decision, because you could be paying an asset-based fee as a function of the plan itself, based on the size of the plan, that you never ever actually see.
Yeah, I think, cost, as you point out, in absence of value, is something to take a look at. There are, I think, some other big differences when you look at the difference between, say, a 401k or a self-directed IRA. Really, many plans don't allow much flexibility when it comes to things like investment choices or withdrawal options as retirees. There was a survey, and what it showed is nearly 31% of 401k plans did not allow for partial or periodic withdrawals in 2020. So some people that are looking for more flexibility withdrawals, an IRA may offer a better choice. On the flip end of the scale, there's some situations where a 401k may make more sense for somebody that's after the age 55. So traditionally, if the 401k offers some flexibilities and they're no longer working after the age 55, they may have some flexibility to be able to take withdrawals and avoid early withdrawal penalties, which could apply in a self-directed IRA up until age 59 and a half. Then if we talk a little bit about some of the investment options, if you're talking about leaving your money in your old plan, if you're happy with the results, but maybe this year the market's got you a little bit more concerned and you want to look at some of the downside strategies, some of the things that we talked about for the other strategies, like hedged equity, protected equities, things like fixed index annuities, iron retirement, using tactical strategies, maybe owning individual bonds to help reduce or eliminate interest rate risk. Those could all be limited choices inside of a 401k. There are a lot of things to consider. So it's, again, I think it's, at the end of the day, there's not one right approach for anybody's individual situation. Everybody's a little bit different. And so you've got to take a look at what your individual goals are, what you're trying to accomplish, and then from there, figuring out the solutions gets to be a lot easier.
It really is all about knowing what you're paying, being able to understand it. And Chaz, you hit it on the head there, talking about value. I've told this story before, and it's a little bit of telling on myself, honestly. My family, we subscribe to probably too many streaming services between Netflix and Disney Plus, and there's a bevy of them. And so we actually recently sat down and said, are we still using this? Are we still watching this? Is this something that's worth us paying the monthly subscription fee for? Especially in the light of some of them going up in rate, and being able to say, yes, we do still watch a good number of shows on this service or that service, because we're able to quantify that. We know the value that we're getting for it, and we know how much we're paying in exchange, and we could say, yes, this is worth keeping. No, it's not worth keeping. We'll never be able to get rid of Disney Plus because of my son. That's a whole other story. But we know how much the bill is, honestly. But when it comes to your 401k and things like that, you probably don't actually know what you're paying in fees unless you've done that deep dive, unless you've had someone like the professionals at America's Retirement Headquarters do that. And without knowing, you can't really assess the value that you're getting for what you are paying. And so that's something I want to task you with. Go ahead and have a fee analysis done. Have the team at America's Retirement Headquarters take a look and show you how much you are actually paying in fees. And then, be able to assess at that point if that is something of value to you, or if there's other ways to maybe shift your assets around to make it work better for you. Give a call, schedule a time to speak with them, 419-794-3030, or go online to americasretirementheadquarters.com. We've been told for years that a 60-40 mix of stocks to bonds in your 401k, that's a good portfolio design. But if you look at that portfolio this year, well, it's down across the board about 15%. Is this just an anomaly year where stocks and bonds are both down, or is the 60-40 portfolio just not cutting it anymore?
Well, it definitely is a unique year with, stocks and bonds being down and, the 60-40 mix. But if you think about, the 60-40 mix of traditional asset allocation, a lot of that came out of what I would refer to as modern portfolio theory. And, modern portfolio theory goes back about 70 years now. So, how
Real modern,
relative, and modern is that? Things have changed. Think about technology, or think about healthcare and what's changed in the last 70 years. I mean, you have cars that'll drive you nowadays. Healthcare advances have been, incredible at what they can accomplish. And the same is true with the financial services industry. I'm not saying that a 60-40 portfolio is completely dead, but I think there could be different choices, that have been a little bit better. The recent stock and bond losses, though, have, in my opinion, improved some of the valuations for the 60-40 portfolio considerably based upon, the combination of things like price to earnings ratios for the S&P, maybe the yield, as you talked about, for the Bloomberg U.S. Aggregate Bond Index. So the 60-40 portfolio may not be back to the level of returns that we've seen over the last decade, or even maybe the last 10 years when you're looking at what the outlook could be. There could be, I think, other financial choices and options that are out there. One of the things, again, that we have talked about is our approach in utilizing the independent income system. So within the independent income system, instead of looking at the traditional 60-40 mix, and as somebody gets older or becomes more, less desired of risk, they increase the bond exposure. I think the independent income system creates buckets of money that is a better approach, because those buckets of money are designed to cover specific time frames. We're taking a look at things like, well, what if there is a market crash in both the stock and bond market? How does that look? We're stress testing the portfolio to say, how do things look with rising interest rates? We can build in things into the portfolio that, can help offset and fight inflation in the future. We can look at then having money set aside for the next 5 or 10 years. And if you have money set aside for the next 5 or 10 years and things that aren't exposed to market risk, then I think the odds become much more in an investor's favor to be successful in the stock market when they have other buckets of money and they can let their stocks grow. Because my opinion is, over the next 5 or 10 years with this pullback that we've seen in the market, I think stocks have some tremendous opportunities that are out there. It's those folks that need the money right now, or those folks that have all of their money in and they're committed, they're really kind of subject to the lottery of the returns of the stock market. So that's what I would say. And one of the things that you should do, if you haven't done this yet, you should stress test your current plan versus the traditional 60-40 mix. Take a look at stress testing your plan and determine what may line up best with your individual risk tolerance and future performance when you know all the different choices that are out there. Those are a lot of good things that can happen. And of course, if you haven't been to one of our university classes, make some time to schedule to come out to one of those events. All you got to do is go to americasretirementheadquarters.com, click on the events tab, whether it's our university talk or whether it's our coffee with the CFO or our First Friday event. We've got a lot of great things that are coming out that will help try to educate you to determine what's best for your individual situation.
Yeah, so I would just add to that, Nolan, I think the 60-40 philosophy is more of just a general rule of thumb, kind of more generic, a benchmarking process that we'll use to gauge, your performance and how you're doing. But, if anybody, gives you a 10-question questionnaire and calls you moderately conservative and puts you in a 60-40 portfolio just because, it's probably an indication that it's may not be one of the most sophisticated, practices, and maybe you should look for possibility of, maybe just getting a second opinion, because as Nolan said, your asset allocation, it may actually come down to a 60-40, but there has to be, a little bit more that goes into how we came to that figure for you. And so really, to me, it comes down to cash flows, when you're going to need some money. You know, at the end of the year, during the year you've got money coming in, you've got money going out, and if there's a surplus or a shortage at the end of the year, you know, that would determine, you know, how we're going to allocate those money to fill up that shortage. And so, very simply, it's just like a big budget. We look to see in the years that you have shortages, we add all those up, and those are, you know, that's your nest egg. That's how much money you're going to need to retire. We'll then bucket those dollars that you need in 5 to 10 year increments, and that kind of will help us determine your asset allocation. It very often comes down to, you know, very similar 60-40 or 50-50, you know, or whatnot, but it might be 35, you know, 65 or something like that. But it's not just the number, it's not the general benchmark that we're looking for, it's the process and the methodology that we use to get there.
Well, I think, you know, something that our listeners need to, you know, write down or pay attention to what you just said that I think is oftentimes overlooked. So if you went into a financial firm and all you did was answer questions about what type of risk profile you are, that's not the whole story. It's really not. I can think of a specific example where I had a gentleman that had come into the office last week, and we took his investments. In our software, we can measure the risk profile anywhere from 0 to 100, 0 being the lowest risk and 100 being the highest risk. Well, the way that we looked at his portfolio, he had a risk score of 30, so one might define that as conservative. The next thing that we did is then we stress test his plan, and we said based upon the withdrawals that he's taking, he had a 6% probability of success to achieve his goals based on his risk score.
Oh.
So as you know, when you look at that, something has to change. Either you can lower the withdrawals and keep your risk down. That's okay. You could maybe go back to work and get another part-time job. Or what you could do is you could increase some of the risk overall. So what we did is we just looked at the plan and we said, hey, you know, we don't have to go really high here, but what if we just go from 30 to 50? Well, simply taking his asset allocation from 30 to 50, it increased his probability of success up to the 70% range. So now, not, you know, going from 6 to 70, you know, felt a lot more comfortable in being able to do that. So risk is more than just a question of how do you feel. Jeremy, as you point out, I think one of the true values of working with a financial professional is, you know, when times get tough like this, our job is to help coach and mentor you to not abandon ship. Don't panic on your plan. You know, the plan was that not everything was going to always work out. The markets weren't going to always go up. We knew that going into it. So it's in these type of environments where you need to take advantage of that, need to be able to, you know, get in there and take advantage of some of the opportunities. As I said earlier, turn that panic into opportunity.
I think theoretically the 60-40, you know, you said it's probably 70 years old, and that's probably accurate. And I think, you know, like I said, theoretically it's probably correct. I've heard things like your age and fixed income. And then when you really dig deep into what that means, you know, having that conservative portion of your portfolio, or when we even take it a little bit deeper to the independent income system, we look at taking, you know, 1 year to 3 years worth of income that is safe and guaranteed. And that's really what the protection that you need to look for is. You know, most people want to have a portfolio that aligns with their risk tolerance, but at the end of the day, it's about getting, I used to call it walking to the mailbox and getting that check, which now is, you know, checking the app on your phone to make sure that money's in your bank account. But that's the important thing to us, especially working with people that are close to or in retirement, is making sure that their needs are fulfilled, that their income level is safe and guaranteed. And there's so many different, more sophisticated products than were available 70 years ago. So that 40% of bonds might not just be bonds. It could be individual bonds. It could be things like we've talked about before, fixed index annuities, things that guarantee, that keep your money safe and guaranteed when you actually need it. And then a portion for growth and a portion maybe in a midterm bucket. That's when we take a look at your overall asset allocation and how it affects you. 60-40 sounds great, but it's not for everybody. There's no one specific target for any specific person. If that were the case, then the federal government wouldn't need to tell us because there'd be one perfect solution. We all know that's not the case.
60-40, or, you know, that nomenclature is not a plan, right? It's just don't assume that because your advisor called you moderately conservative, that you're going to be okay. You know, moderately conservative is really, to me, one of the most ambiguous terms in our industry. It means to me that when things are going well, yeah, I'm moderate, but when things are going poorly, how dare you lose me money? You know, it's like very difficult for us to identify what that means. So don't let people use generic terms on you.
Yeah, the same advisor or same client who was conservative today when the market's down was aggressive 5 years ago when you couldn't lose money regardless of where you put it.
Yeah.
Yeah, it's very easy to say that you're comfortable with having a high level of risk when the markets are swimming along, like you guys said. And, you know, when it comes to the 60-40 rule or your age and safe money, they're not, they're better than nothing, certainly, as far as a plan goes. But you probably want something a little bit more dynamic than that. It's a good place to start from. It's the same sort of way that, you know, you shouldn't at least go to WebMD and type that in and go, well, that's the result it gave me. That's what I've got. No, at that point, you know, you've got an idea. You've narrowed down what it might be, what it might not be. But then you want to go to professionals. In this case, you obviously want to go to a doctor and really fine tune and say, okay, I don't think it's this. I don't think it's that. Please tell me that I'm not dying, because the first thing I typed in was the plague. Hopefully, it's not that situation. But you want to have a more customized plan come into play, and it's going to vary from person to person. Obviously, it might end up being 60-40 at the end of the day, but more often than not, the numbers are going to differ a little bit. To figure out the numbers that are going to work for you, here's the number you need to call: 419-794-3030. That's 419-794-3030. Don't forget, lots of events coming up here at BGSU at Levis Commons. To find out more about those and to reserve your seat for those events, go to americasretirementheadquarters.com, click on the events tab. The guy's actress Cameron Diaz. She's actually coming out of an 8-year retirement, unretiring from Hollywood, to make a Netflix movie with Jamie Foxx. But she admitted to him in a phone call that the thought of re-entering the working world was causing her anxiety.
I feel excited, but I don't know how to do this, you know?
I understand. Listen, I got somebody on the other line that can help you with this.
I would love that. Any kind of tip I can get.
All right, hold on a second. Tom, you there?
Jamie, what's up, man?
Chilling, man. Cameron, it's the GOAT.
What?
Hi, Cameron.
Oh, my is this Tom Brady?
I was talking to Jamie, and he said you need a few tips on how to unretire. I'm relatively successful at unretiring.
Honestly, exactly what I needed.
Well, guys, I'm going to jump off and let you guys chat it up.
Perfect. We'll take it from here.
And mind you, like I said, Cameron Diaz coming out of an 8-year retirement. Tom Brady was retired for all of 40 days. What do you tell clients who feel anxious about unretiring, the thought of that, and how does it affect their financial plan?
I thought she was a Far fan from that movie I saw.
Yeah, it seemed longer than 8 years for sure. I haven't seen her in anything, but
It is wild. It's been that long. You know, I think people unretiring, you know, again, it comes down to, is that what they're wanting to do, or is it that what they're doing because they feel forced to do that? That's a big difference. I think, you know, ultimately, people are a little bit nervous right now, and if you're nervous and you're thinking that you have to go back to work, and that's something that you don't want to do, I'd say, again, run the numbers, get a second opinion, take a look, and figure out, you know, is that really something that you have to do, or is, you know, this short-term volatility something that you could get through? I don't know about you guys, other pointers or tips that you would give too.
I think my mother just retired. She had a retirement party just a couple of weeks ago, and worked for the police department, and the chief didn't want her to go, and now she's got other departments that are calling her, hey, can you come in for 8 hours a week? And, you know, she's been retired for a couple of weeks now, and people are asking her, what are you doing? How do you like retirement? And she's like, well, right now it just feels like I'm kind of on vacation. And they're telling her that, you know, you'll get used to it. And I don't think that she's necessarily nervous about the markets, because she's got a great financial advisor on our team here. But I think she's more worried about finding ways to fulfill her day, and you know, finding whether it's a hobby or something with even if there's something that could provide a little bit of income. So I think so her retirement probably, and everybody has a little bit different definition of retirement.
yeah. I actually have been getting that question or situation more frequently with clients. Had a situation where a teacher, a client of ours we just brought on, was asked, you know, to come back to school and teach beginning in the fall, and so she did that, and I think she enjoys what she's doing and doesn't mind going back. She's not going to have the same benefit structure, and so that's something to me to consider, because I asked her, I said, well, why not? She won't get the bonus for the or 401k and things like that. You know, she's a part-time employee, so insurance and other factors don't apply. So, you know, I asked her, I was like, why not just work full-time for another year instead of, you know, most time and not have all the benefits? And she's like, oh yeah, I didn't think of that. So I guess as you're kind of going into the situation, maybe just be sure, you know, look at the fact that right now COVID and some of the other supply chain shortages or whatever the disaster du jour is causing, you know, a lot of employers to just not have enough help. And so there's probably going to be a good chance that if you retire now, you've got an opportunity to work anywhere you want really in the country. So, you know, consider that if you want to get out and do something different. There's certainly going to be an opportunity, but maybe it would make sense to, you know, stick around and do it for another year, because, you know, you're going to get, you know, one thing to consider is your Social Security benefit. If you're not already drawing Social Security, if this is one of your peak earnings years, and if you can go one more year and earn, you know, more money in that last, you know, in those final years, the government's going to take your final 30 years, 35 years worth of earnings to calculate your Social Security payment. So if you're in your peak earnings years, maybe it does make sense to stick around for another year, bump up your Social Security potentially, and it does make your plan look a lot better. I know when we've run the scenario of waiting for 1 year, it does increase the probability of success usually for your financial plan. So that is definitely something to consider.
Whether it is retiring just normally, retiring early, or unretiring, we hope it's something that you do out of your own desire, not something that you have to unretire out of necessity. But in any event, it comes down to checking with the plan, making sure the numbers align, that it is feasible, that it is the right move for you. And if you need help crunching those numbers, again, the team at America's Retirement Headquarters, they can help you with that. Weigh the pros and cons and maybe show you a better way, like Chaz pointed out there, you know, going back full time instead of going back most time, and being able to retain those benefits that, you know, teaching an extra year full time would benefit, would help out with. 419-794-3030. That's how you schedule a time to speak with America's Retirement Headquarters. 419-794-3030. You can always find them online, americasretirementheadquarters.com. Like I said before, if you missed previous editions of the show, or you just want to catch up, you know, there are other editions you want to listen to again or share with your friends, go to YouTube, go to Spotify, Apple Podcasts, Facebook. Just search for America's Retirement Headquarters, all there for you on demand. And we thank you for joining us this week. Please take care of each other out there. And guys, as we wrap up, we'll leave you with the final word.
Yeah, another great quote this week. George Bernard Shaw, what he said is, you don't stop laughing when you grow old. You grow old when you stop laughing. So have a great week, everybody. Thanks for tuning in. We'll be back same time, same channel, right here on 1370 WSPD. This is America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates.